Hi everyone. Wall Street banks just slashed their recession forecast from 60% to 40%. Retail investors are celebrating, but market crash in the past century followed this exact pattern euphoria right before devastation. The yield curve just completed a sequence that only happens once every decade, and institutional investors are repositioning billions while you're reading this. If you miss what happens in the next 12 to 18 months, your portfolio faces potential destruction, while dividend investors collect checks and sleep soundly. The yield curve just normalized after remaining inverted for over 780 consecutive days, the longest stretch in recorded history. The 10-year Treasury now yields 4.13%, while the 2-year sits at 3.58%, creating a 55 basis point spread. Most investors dismiss this as meaningless bond market noise. They're catastrophically wrong. The danger doesn't strike during inversions. It strikes immediately after normalization. Study January 2006. The curve inverted, triggering brief panic. Then it normalized mid-year. Stocks rallied. The economy appeared bulletproof. Unemployment stayed low. Housing prices kept climbing. Consumer confidence hit record highs. Exactly 18 months later, the financial system collapsed. The Lehman Brothers disintegrated. Bear Stearns vanished. Washington Mutual failed. Trillions evaporated overnight. The Dow Jones plummeted 54% from peak to trough. Identical pattern emerged in 2000 before the dotcom annihilation. Curve inverted in early 2000, normalized by summer, then obliterated tech stocks trading at absurd valuations. Companies with zero revenue but massive market caps evaporated. Pets.com, Webvan, eToys all gone. Entire retirement accounts disintegrated. The Nasdaq crashed 78%. Wall Street banks recently reported 40% recession probability, down from 60% months earlier. Markets interpreted this as bullish news. Fatal mistake. When recession odds decline, complacency surges. Investors increase risk exposure. Margin debt expands. Valuations stretch further. That's precisely when trapdoors open. Consider current economic fundamentals. Credit card debts exceed $1.2 trillion, an all-time record. Delinquency rates hover around 3% after 11 consecutive quarterly increases. Americans are barely making minimum payments while average interest rates hit 24%. Debt over 90 days past due reached 12.3%, highest since 2011. The facade looks stable because people are treading water, but that water deepens daily. Interest rates averaging 24% on credit cards are crushing borrowers. The Federal Reserve remains trapped. Cutting too aggressively reignites inflation. Cutting too slowly breaks the economy. They've navigated between Scylla and Charybdis with zero margin for error. Meanwhile, sophisticated analysts place recession probability above 90% based on hard data including manufacturing contradictions, leading economic indicators declining and consumer sentiment deteriorating. Market consensus says we're safe. Top analysts are screaming warnings. History proves the analysts win every time. The AI stocks dominating portfolios, positioned for annihilation. Companies with zero profitability, stratospheric valuations, and massive debt get decimated first during downturns. Price-to-sales ratios exceeding 20 times become death sentences. Investors said different this time about internet stocks in 2000, about housing in 2008, about cryptocurrency in 2021. Now they're saying it about artificial intelligence. The script never changes, only the actors. Companies generating consistent cash flow and paying rising dividends become the only refuge during economic storms. Not because they're immune to downturns, they are not, but because they possess financial fortresses that weather catastrophes while speculative plays disintegrate. Enter the Schwab U.S. Dividend Equity ETF. While tech stocks party, SCHD has constructed one of the market's most defensive portfolios. The current yield is 3.80%, more than triple the S&P 500's 1.2%. That's $3,800 annual income per $100,000 invested versus $1,200 from the broader market. The yield isn't even the compelling part. SCHD tracks the Dow Jones U.S. Dividend 100 Index, screening companies through 4 critical filters: cash flow to debt ratios, return on equity, dividend yield, and 5-year dividend growth rates. This ETF exclusively holds companies proven to survive and thrive through chaos. No speculative plays, no unprofitable growth stories, no companies burning cash. Historical data reveals the power of this strategy. Between 1973 and 2024, dividend-paying S&P 500 stocks delivered 9.2% annual returns versus 4.3% for non-payers. That's more than double the performance. Companies consistently raising dividends achieved 10.2% annually, turning $10,000 into over $90,000 across 50 years versus just $24,000 for non-dividend payers. SCHD captures these exceptional companies. Top holdings include Amgen, Cisco Systems, AbbVie, Merck, and Coca-Cola. Not exciting growth stories, battle-tested cash-generating machines with decades of survival proof. These companies existed before the internet. They'll exist after whatever comes next. During economic warfare, boring becomes beautiful. Institutional investors recognize this reality. SCHD manages over $70 billion, with recent inflow exceeding $5 billion. While retail investors chase AI hype and meme stocks, sophisticated money quietly accumulates quality dividend payers. Pension funds, endowments, family offices, the investors who measure performance across decades, not quarters. They've studied history. Growth stocks get annihilated during recessions. Cash-burning companies get slashed repeatedly. But dividend-paying businesses generating consistent cash flow, they become the safe harbor everyone wishes they'd purchased earlier. When everyone's scrambling for lifeboats, you want to already be sitting in one. SCHD delivers with a microscopic 0.06% expense ratio. For every $10,000 invested, annual fees total just $6 versus $60+ for actively managed alternatives. Over 30 years, that fee difference compounds into tens of thousands saved. The fund has increased dividends annually since 2011 inception, through COVID when dividends got slashed across markets, through the 2022 meltdown when growth stocks collapsed 60%, dividends consistently rose. SCHD holds 103 companies with 41% allocated to top 10 holdings. Energy comprises roughly 19% after recent reconstruction, positioning for commodity strength during inflationary periods. Healthcare, consumer staples, and financials round out major allocations. Technology deliberately outweighed by 15% versus category peers. SCHD has recently underperformed while the S&P 500 surged. Most investors view this as weakness. Sophisticated investors recognize opportunity. The fund outweighs energy, consumer staples, and healthcare, sectors that dominate during economic stress. It underweighs tech by 15% versus category peers. Feature, not bug. When rotation arrives, and it always arrives, SCHD will be perfectly positioned. Those boring holdings will become the most desired assets in portfolios. Understand the timing, yield curve normalized, recession indicators flash contradictory signals. Consumer debt sits at records while delinquencies climb. Corporate profit margins face compression. This configuration has preceded every modern downturn without exception. Not if, when. Historical analysis shows recessions typically emerge 12 to 18 months post-inversion. We experienced the longest inversion ever recorded. The danger window is open now. Execute this 3-step strategy immediately. First, build SCHD positions through dollar cost averaging over 3 to 6 months. Invest consistent amounts regardless of price fluctuations. Don't attempt perfect timing. Even professionals fail at the game. Second, secure 6 months of expenses in cash. High-yield savings accounts still pay over 4%. Lock this safety net immediately before rates decline further. Third, stop chasing performance. Stocks excelling over the past 2 years typically suffer most over the next 2 years. Market cycles punish crowds mercilessly. The hottest investments become the coldest fastest. The yield curve delivered its final warning after building pressure for over 2 years. The release has occurred. The test begins now. Institutional investors are executing, rotating from overpriced growth into quality dividend payers like SCHD, reducing leverage, building cash positions, preparing for volatility they know is coming. Will you join them or hold overpriced growth stocks when reality strikes? This isn't fear-mongering. This is preparation based on irrefutable historical patterns. Data is unambiguous. Patterns are obvious. Opportunity sits directly ahead for those willing to act contrary to crowds. While masses celebrate supposedly declining recession odds, position yourself to not merely survive, but profit from the coming downturn. When markets crash, quality dividend stocks don't disappear. They go on sale. SCHD holders won't just weather storms. They'll collect rising dividend checks while shares compound back stronger on the other side. The yield curve issued its final warning. Action is your choice. If this analysis revealed what's genuinely happening beneath surface-level market narratives and why SCHD could safeguard your wealth, hit that like button and subscribe for the next critical warning signal. Drop a comment. Are you accumulating SCHD or still chasing tech? What percentage of your portfolio is allocated to dividend stocks? Let's discuss now. This content serves educational purposes exclusively and does not constitute financial advice. I am not a financial advisor. All investments carry risk. Past performance never guarantees future results. Always conduct independent research and consider consulting qualified financial professionals before making investment decisions. Smash that like button, share with someone who needs this, and subscribe for real market insights. Here's to protecting your wealth and investing smart. Profitable investing.